Hello, welcome back to Balance Your Books podcast. Hello, Kimberly.
Hi, Keena.
And glad to see you today. And let's get going.
Let's get into it. As we always say, we are out there. We are available, the podcast on Apple Podcasts, Spotify, and YouTube. If you want to look at our beautiful faces while we're talking, join us there. Please like, subscribe, and share. Leave comments. Review. Oh, I'll never say do a review. You can do a review on Apple and Spotify. Give us a 5-star rating. Let people know that, this is a good thing that we've got going on here with your Balance partners. And if you want to get in touch with us, we have some websites. You want to tell them about the websites, Keena?
Sure. So we have been expanding our footprint. So if you want to hear more about our firm, it's yourbalancepartners.com. Mm-hmm. If you like our podcast, like, hey, I just want to listen and get the information, it's balanceyourbookspodcast.com. And now we've got something that we've started in the last month. It's called Cash Flow Confidence. And Cash Flow Confidence is our live sessions. We've gone live, people. And and so where you can ask questions, if you're like, let me see if these chicks really know what they're talking about. We can, you send us a question and you can come on live and ask your question. And that's called Cash Flow Confidence. And to sign up for those, you can go to cashflowconfidence.net. Cashflowconfidence.net. Someone scooped our .com. I'll talk about that one time.
And you sign up on Eventbrite. It is free, but we have you sign up so that you can get the link to join us live.
Exactly.
So it is free. And then if they sign up, what do they get?
They also get a little free gift, because we want small businesses out there to be confident about their cash. And so we have a tool that we like to use that we're like, we'll share it with the people, and give you a little bit on how to do it. But 9 times out of 10, you're going to need to call us and have us help you do it, honestly. But you can get out there, give it a shot, and start to get more confident about your cash.
All righty.
So today's topic. So we've taken on a couple of different things because, as we've always mentioned within Balance Your Books podcast, is we want small businesses to win. It's why we left corporate America to get into this. Why we sacrificed dollars that we were making in corporate America to do this as service to the community, because we recognize that we have information, we have skills that a lot of people are not having in their business. So we said, hey, we need to make this available. How can we make this available to more businesses so that they can grow? There is abundance at the table for everyone. So
everyone can succeed. There's enough for everyone.
Yes.
There is enough for everyone. It's just some have more than others. But there's enough for everyone.
There's enough. So let's look at a clip, because we talked in a previous podcast about Fawn Weaver and Uncle Nearest, and another business, particularly a Black woman-owned business that we want to be successful, is Pinky Cole and Slutty Vegan and some of the other avenues that she's going down. And so I saw a clip from her recently that I thought she gave some really good nuggets that I would love for us to get a little bit more into. So if we could share that first, her interview with the Breakfast Club.
Talk about your decision to file for bankruptcy after buying your business back.
Okay, so entrepreneurs, I need y'all to hear me. I don't know if y'all saw a video circulating where I said, do not put anything in your personal name. Mm-hmm. Have y'all seen that clip? Mm-mm. Find it after this interview. So the reason why I said that clip is because here it is. At my peak, 14 locations, Slutty Vegan. It cost me between $800,000 to $1 million to open up each location. Mm-hmm. I raised $25 million in 2022. Company got valued at $100 million. We kicking in the middle of a pandemic, in the middle of a time where inflation is through the roof, right? Inflation is through the roof. Supply chain is crazy. So there's like a 6X on everything. Mm-hmm. So we did everything that we said that we were going to do in business. The problem is that when you grow that fast, right? Sometimes you put basketball players on a golf course. Mm. You understand what I'm saying? Mm-hmm. So you got people that do an incredible job in their skill set, but then you position them somewhere else and they can't do what you need to do to take you where you need to go. Yeah. So as a result, we got $20 million in debt, right? And as a result of that debt, we were drowning. So yes, we were making money, double-digit millions. But if your payroll is high and if you have all of these costs and everything is adding up, your bottom line is going to be red. But what I didn't know is when we were growing the company, everything I'm just signing my name on, personal guarantee, because nobody ever thinks about the business that it will fail.
Yeah.
Nobody thinks like, okay, this ain't going to work one day, so don't do that. Especially not me. Like I have this company, lines down the block. Everybody loves this brand. And then one day I look up and I got all of this debt. And I'm like, okay, cool. I can file an assignment for the benefit of creditors. Okay. Do y'all know what that is?
No.
That is bankruptcy's first cousin. Okay. So it's an out of court procedure that you file if you need to restructure your business. It cleans your cap table. So if you have investors, you no longer have investors. I was no longer the CEO, none of that. Okay. So I did not own a company for 43 days. And the estate that took the company, they took the assets and they took the debt so that they can sell off the assets so that they can pay off the debt.
Yeah.
Okay. And then they sell the business to somebody who wants to buy it. But who else gonna buy Slutty Vegan stuff for me? So 43 days later, I bought the company. But here's the kicker. After I bought the company, I'm like, okay, cool. Everything is good. Next thing I know, the creditors are coming after me personally because I'm the party responsible from the old co.
Yeah.
So even though the old co is dead and I don't have to deal with the old co no more, they're coming after me because they like, all right, she's a public figure. She got it. She can pay for it. But smart entrepreneurs know is that you don't really hold no assets in your personal name.
Yeah.
On paper, I ain't got nothing personally. And as it should be. So, okay, all right, you have to file for bankruptcy because I got lawsuits. I'm walking into St. Regis. I'm getting served lawsuits, all of these things from OldCo. So now this becomes a part 2 of that restructure. But, you know, the internet be internet.
Now, we also seen something that they...
So we can stop there.
Yeah,
They-
let's stop there.
in your house.
Yeah. So there's a lot of good stuff in there.
That is it's a lot. And when she starts talking about old co and new co, that first part where she's signing those personal guarantees.
Yes.
And we've talked about this before, though. We have talked about how sometimes you have to put your name on it. You have to have a personal guarantee. If your business doesn't have the liquidity, it's not as solid, if it doesn't have the history
and the credit rating.
The credit rating to back up what you're lending, what you're trying to borrow, then yeah, you may have to sign a personal guarantee. But when you do that, then you are personally guaranteeing that it will be paid.
Yes. So let's start there. So let's start at that part, right?
Okay.
So this is a company for those who may not be familiar out there or who are watching from, they aren't in Atlanta or where in a city where Slutty Vegan expanded to. So Slutty Vegan, Pinky Cole started this company in Atlanta, started as a food truck, and it's a vegan fast food company. And so she had lines down the block. It got a really great following, excellent marketing. She was great, master marketer, and got it out there. And so then she expanded it as she talked about, expanded it really quickly. I mean, the amount of stores that she did overnight, I mean, it was like within a year or two, it was a lot, right? So that's what she was talking about. So she was talking about how do you finance your growth? And that when she was doing that, she was doing it with personal guarantee. The reality is that as a small business, 9 times out of 10, you are going to have to personally guarantee a loan.
Yes.
Unless you get an investor who then wants equity in your business for giving you money, 9 times out of 10, you're going to have to personally guarantee the loan because they're going to ask you for your personal financial statement. If you have which means you have to have assets personally. You have to have a house or, investments, retirement accounts, things like that are your assets that when you are personally guaranteeing, someone can come after them if you don't pay the debt.
Yes.
The thing is, it's interesting. What I'd be interested to know, which probably wouldn't really the Breakfast Club, like I would love to have her on where we could say when she said she raised $22 million to help fund her growth. What did that raise mean? Did she raise that as debt? Or did she raise that as a mix of debt and equity? And that, and because it's a private company, we don't have that information.
Mm-hmm.
But if she raised that as debt, 22 million is debt, and she says she's $20 million in debt, then that's just the debt she already had. Right. So the way that she phrased that sounded to me like she maybe had some piece that was equity and some piece that was debt that she was using to finance. The part that in order for you to all of a sudden spring up and be $20 million in debt so quickly, that tells you did not have good forecasting. So part of before you even went into the raise or going after the debt, what kind of forecasting of growth did you do? Right. What type of strategy did you do? Because it sounded like she knew her number around how much it cost to open a location, right?
Yes.
So she said it cost between $800,000 and $1 million to open a location. Mm-hmm. Did she do the analysis around should those locations be company owned versus franchising? Because franchising spreads debt.
Right.
Because you don't own every location. Mm-hmm. Locations are people buy into your franchise. You as a franchisor makes money and the franchisee takes debt. So there were different ways that she could have grown her business that working with the right finance team, folks like us at YBP, we could have said, well, let's sit down and let's plan out which way. And when we do that, we also plan out the risk of what if it doesn't work. Because one of the things that I love that she said is, because when she was signing, and as an entrepreneur, you don't think that it's not going to work.
And
they never do, which is
you thought it would.
Right. But what was so beautiful about it, Kimberly, is I appreciate her so much for saying that, because entrepreneurs have to have that type of optimism. The work is so hard. They have to have that kind of optimism. That's why you have to have us or people like us, because we are not optimistic like that for you. We are the other angel on the other shoulder that says, I know you love it and think it's going to be great, but I got to run these scenarios that if it doesn't and you had to pay back, and what's our strategy and what's going to be. So we can't really get that much. Maybe let's do 3 company-owned locations. Let's get those profitable, and then let's put the next ones out at 2 years out, right? And based on the profitability of those, and have that profit fund the next one instead of doing it all in debt, right? So those are the kind of things that having the right team, when she was doing that strategy part and doing that raise, what portion of that was equity versus debt, I think is what, based on what she was saying, that sounds like where she got tripped up.
Right.
What was your
take
take on it?
I like what she said. Well, that and to bring it, small business owners, maybe you aren't borrowing money just yet. Okay, maybe you're not doing that yet for your business, but a real personal analogy is even a mortgage. When you're buying a house, right? You should figure out how much house you should own and not let the mortgage company tell you how much house you can own.
Yep.
That's that little angel you're talking about, because they can say, oh, you're making this, and look at your debt and say, okay, well, yeah, we can give you, what is it called? It's been such a long time since I got a house, but when they gave you the paper to take, that you could take.
Oh yeah, yes. Your pre-qual. You
get a pre-qual for $400,000. But when you look at your budget, you're like, no. I want a house for $250,000.
Yep.
And so that's that, being able to look at what you can do and what you should do.
Yes. Because she said her valuation was 6 times. She said she had $100 million valuation. Folks, valuation is just how somebody feels.
Right.
It's not real dollars.
It's not real dollars.
It's just someone thinking like Amazon. Amazon was valued at like $1 billion when it was losing money. It had net losses, but its valuation was a lot. Now, it turned out in that case, it exceeded its valuations, right?
Right.
But a lot of companies do not.
And the other thing about valuation, to bring it back home to something personal, let's look at your stock investments, right? The stock market was going all over the place. When the war started, a lot of our retirement funds took a dip, right? people are saying, I'm losing money. No, you're not.
Yeah.
You're not losing money until you sell that stock.
Mm-hmm.
And some people got scared and sold the stock. That's kind of like the valuation. Yeah. If you sell the business today when it's valued at 100 million, you'll get 100. Maybe you could get 100 million, right? But you have to sell it today for it to truly be tangible.
To say that
Stock
really
market
is 100 million.
Right. So to say it's 100. So even when the stock market went down, I wasn't saying I was losing money because that wasn't true. I still had the stock. And when it came back up, because I didn't sell my positions, now I'm not going to say I'm making money, but that's the value of it today.
The value. Yes.
The value, but it's not tangible. It's not real until you sell that.
It's not real. And so I love your analogy of the house, because so for Pinky and Slutty Vegan, the valuation of 100 million was why let's just assume it was all debt. We don't know what Pinky actually did.
Yeah.
But let's assume the whole 22 million was debt. Yeah, they did that because they think you're going to shoot here. You have some, you probably have some assets, and but you didn't have enough assets in the business that you didn't need that personal guarantee. Right. So they had to do the personal guarantee because you have assets. You probably had a house, cars, you probably had investments, things like that. So those are things that shored up that number to get it to the 22 million.
Right.
So, the hindsight 2020, which I wish we were working with her back then, because maybe she could have avoided it. But sometimes you got to live through things to just understand it. And it gives us this education, this gift that we can give other small businesses. So it's, looking at that piece of it alone right there. Let's make sure people understand, just because, think of like how Kimberly mentioned the house, just because someone says I can give you that much, that may not be what you need to do. The best way to know what's the best number is adequate, really good, strong forecasting that's done with real finance people who are like not optimistic.
Right.
They are realistic. So they're going to have some growth, but they take usually what an entrepreneur says, I think I can grow 20 times. We're like, okay, great. We're going to make it 5. And then if you exceed it, great. Awesome. But we're going to do it based on what your historical has been, based on what your strategy is, based on what we've seen the margins at this other location. We're going to use that same number at this location. But now that you've added the actual part to get it open, it's $1 million. We know it's not going to break even until this date. So if it's not going to break even till this date, then you have to put more money into it. So that's the kind of analysis that we do on the finance side. They say, okay, this is when we think it can make money. So therefore, how are you financing that? How are you paying for that? How are you paying the debt related to it? So we don't come into it. We come up with hard numbers that then tell us whether you can do something.
And that's what the big boys do.
Yes.
That is what the major corporations do. If they're going to buy a business, they hire an external valuation firm. They're not just going to go by what the acquiree says.
Yep.
They'll say this is their finances, right? Usually those numbers that the acquiree has, they want them to be audited. Somebody has confirmed that these are your numbers, and then an external valuation firm will come in and say, okay, based on this and these projections, this is what it's valued at. Not what we feel like you want to buy it for, not what they want to sell it for.
Yep.
There's typically an external firm that comes in to tighten up those numbers and say, hey, this is what you should pay for this company.
Yep. Yeah, because all depending on, who's doing the valuing and what they think they're going to get out of it, your number could be different. Because to your point, she'd say that whoever did her valuation at 100 million, someone probably would have bought it at 50. Right? Because when they go through and do the due diligence, how many locations did she have open at that point? If it was a purchase today, it might have even been a purchase at 5. At 10. Right. So it's so there's a huge gap depending on who it is doing the valuing. I think the second good thing that was really great, and we appreciate her transparency, is where she said, I had people, were they basketball on the golf course or What is that? What she said? So that means what she was saying was she was asking people to do things that were not their skill set, and I could probably put money that she had some people doing finance that didn't really know what they were doing in finance. And making sure, as we've talked about in previous podcasts, we're CPAs, but there's all kinds of different kinds of CPAs. There's all kinds of different kinds of people with finance degrees. And so just like if you were going, what we like to use as the example is the medical profession. You can have a heart surgeon, you can have a gynecologist. Your gynecologist is not going to do your heart surgery, and your heart surgeon is not going to deliver your baby. Right. So because they're both doctors, they both have gotten a lot of education. They both have degrees. It could be accredited. It could be reviewed well and all that great stuff. But each one does not do what the other one does. And it's the same thing, even within finance. So you have to understand that when you're hiring people, ask them about what kind of experience have they done? What kind of things have they done? What is their expertise? If someone, even a CPA, even in our profession, says they can do it all for you, run, because that's a lie.
Now a firm can. Because they will have, like us, your balanced partners. They will have people who have different areas of expertise within the firm.
Yes.
But one person,
yeah.
I would hesitate. But also about that statement, what I like that she said, and a lot of times small businesses, and I've been guilty of this myself, having basketball players on the golf course or having people who are not necessarily skilled. As a small business and you wanting people to succeed, sometimes you hire people and you're going to train them up and you're going to show them how to do it. And you may have had somebody who was responsible for managing one store.
Yeah.
And they were great at managing that store. And you said, okay, you're great at managing the store. I'm going to send you to New York and open 3 different locations in New York.
Yeah.
And that might have just been too much.
Right.
And it can happen if you are going to invest the time and money into training them into doing it. But like we said before in one of our, like the LeBron James model, where you take your people and you get them trained up before you send them to open the stores. But a lot of times we'll bring people in and we see that they're good in this area. It's like, oh, yeah, they learn quickly. Yeah, I think they'll be good in this area. And sometimes it's not that they can't advance to a bigger area of responsibility, but even they can be overwhelmed. They can be overwhelmed. Like, yeah, I can do it. Can I do it? Can I, So if you are busy trying to grow the business and be the brand ambassador, you may not have the time to encourage and build up the person like you were in that one store. When you send them off to open up 3 stores in another state. So I think that's part of what she was saying too, because they grew too fast. She admitted they grew too fast and they were doing it all. And she's like, well, we could do this here in this other area and I'm going to let my people do it.
Yes.
But your person might just be comfortable being in the one store, managing that store.
Yes. Yes, exactly. And then hiring someone who has expanded operations before would have been a better use of the funds, right? Because I know that, you're right, because they may say, well, I want to reward you because you did so good. But the reality is that people, when you're doing those kind of things, you got to get people with experience and who know how to do that and what's the right way to do it and that kind of thing. It's and the growth trajectory, growing too fast is that to me is the third thing, is the timing of growth and making sure that you don't want to grow too slow. Because we have one client that I've encouraged them, you all are doing great. And you got to strike while the iron's hot. And I get why she did it. It's like to strike while the iron's hot. You got the buzz. You're on magazine covers. You're doing all these different things. How do I strike when it's hot? But you also have to really manage that growth to make sure that it continues to be profitable and that you aren't taking on too much debt. Because that's what happened is you took on more debt than what you were churning through from a cash flow perspective, which leads you into bankruptcy. So you can definitely be making a lot of money and and still go into bankruptcy. In that case,
you could be making money. You could be making money to cover your operations without considering that debt servicing that you have.
Yes.
We can make money and we can pay our payroll, but we got to pay our payroll. We got to service our debt with so many other things we have to do to make this business work.
And that's the cash flow.
Right. And so I will say this, Keena, because you mentioned it. I don't know if you knew this, because, I'm over here with my little research.
Yes.
And, when she reacquired her company, her goal is to go into a franchise model.
Mm-hmm.
So that is what she's doing. She is pursuing a franchise model. That's part of the long-term strategy.
See? I wish I could have talked to you, Pink Cake, before you did all this. Yes, because it's that they were taking on that's why I said I knew immediately that the forecasting
we talked about this back then.
Yeah, we did.
When they were opening, they're in Brooklyn, they're here, and we're like, and we didn't even have did we have the firm? I don't think we
No, we didn't.
We were just talking as accountants.
Yes.
We were just talking as accountants, like, ooh, they're growing pretty fast.
Yeah. And it's like, I wonder how they're financing that. What are they doing to manage that? Because when we decided to even do that, or even before we decided to do this, I've always wanted, and I think we've always wanted businesses to win. So every business that I walk into, I'm like, how are you making money? How are you managing your costs? How are you, what could you do to do it better? How could we, because I'm thinking through your business strategy. And some of them like, oh, they're kicking ass. That's really good. Like they decided to do that. That was that was smart, And
I've been guilty of sometimes like, hey, can you tell your manager to come here? And say, hey, have you considered doing this? Or and I'm real guilty at, did you know that this is spelled wrong on your menu?
Yes.
That really, or, something like that.
Right.
Or, your menu says this, but this is what is going on. And especially pricing.
Right. Which we did a whole podcast. It was a podcast around pricing, right?
Yep.
Yes.
We did a podcast about pricing and making sure you include everything and not nickel and dime it. Or what was it
Pencil
called?
whip.
Don't pencil whip your customers. Yes, we did all that type of stuff. I will. If I go into a new business and you want to see it succeed, and you're sitting there, you're like, okay, the food is good, the service is good, but I will say, hey, have you considered this? Yeah.
Right. Like, you're spending a lot on to-go packaging. Yeah, because I mean, this is how in thinking about people's business, I'm like, no. I'm taking the food home. Don't just automatically give me the fork set. Ask me, because that's money. That's money.
Right.
You got to make sure you're managing your expenses. So, so to those out there, if you don't need the fork set, don't take the people's fork set just to be taking stuff. For a small business, that is real costs. For any business, that's real costs. So it's like, let's help each other. Like, we talk about there being abundance. There's also responsibility to me as a customer to help support. You want those businesses in your community. You want to be able to come. You want the cheers where everybody knows your name when you come there. And that's for the old school. If you're younger, look that up. And, so it's for them to stay there, they have to manage costs. So you just randomly taking things, or, you want to eat it there, but you still want a to-go container, not thinking about how much that costs somebody. Those kinds of things. Think of, it's those little things matter a lot to a small business, and matter a lot to them being able to manage their costs so they don't get to debt, so they don't do personal guarantees, so they around things that they more than what they can afford, So it's like all of us working together, helping to support those businesses, help them grow. And then they help our community, and then they hire more people in the community. It's the lightning. The lightning, it just goes and goes when we all are in it together.
Yes, exactly.
All right. Well,
Good stuff.
I know. So thank you, Pinky, for your for being open and sharing that, because I think it'll help
Transparent.
a lot of people.
Yes, and that's one thing I've always loved about her is her willingness to be transparent and help other people.
Yes, yes.
Bring other people along, even in the failures.
Yes.
Being transparent.
Yes.
So,
and I wanted to talk about it because I know, you know, some things get lost. You got to understand the finance behind it, the accounting behind it.
Mm-hmm.
So
right, and the marketing, because she's on Real Housewives of Atlanta.
Yes,
so that's part of the storyline, and it's the glamorous, social media aspect. But even with that, she is giving you real solid advice.
Mm-hmm.
Learn from my mistakes so you don't have to experience.
Right.
And there's a phrase like that, but I know that's not it.
Yeah. Call people like ourselves to help you.
Learn for it.
Yeah. Mm-hmm. Call people like ourselves to help you, and then listen, and then discipline yourself against it.
Right.
You got to listen.
Listening is key. You got to listen.
Yeah.
Yes.
Because we know a lot of them that don't. All right. Mm-hmm. So now, shooting the topic of today. So, Kimberly, we went to the movies yesterday.
Yes, recently.
To see a great new rom-com.
You, Me, and Tuscany.
You, Me, and Tuscany. Produced by a fellow FAMU grad, Will Packer. I got to throw that in. Rattler love. Yeah. At least.
Yeah. Can I just say something? I got to say this. So, podcast land, Keena's having issues with her car, so I let her borrow one of my cars. And so
that sounds real bourgeoisie. Anyway. Well,
let me state that both of these cars are paid for, and both of them are over.
Yeah, I must add that on because it sounded real. It sounded real like one of my cars.
Yeah. Look, one of my cars. But she's driving the 20-year-old car.
Yes.
Anyway, I will say, since you brought up Will Packer, FAMU, I love when I saw you pull up with that.
Oh God, it does have it on there.
Plate on the front. I was like, she driving around repping A&T on the front and the back.
Oh gosh, yes, Lord, I didn't think about that. I need to put something over the top. That's
going to be incentive for you to get your car fixed even quicker.
Right.
Anyway, I digress. So we went to see the movie. It is such a cute movie.
Very cute.
Of course, it's a rom-com, so there was some reality just thrown out the door.
Yeah, doesn't matter in a rom-com. Who cares?
Right, it doesn't matter. You know what's going to happen in the end. You always know that if you just be truthful up front, we wouldn't have a movie.
Right.
But we always know what's going to happen in the end. I love my Hallmark movies because
yes,
the state of the world today, I need guaranteed happy endings.
Yes. And that's the thing. It's like, give your brain a break. I think sometimes people, they get real critical of like little rom-coms or Hallmark movies or what have you. You need to give your brain a break. There's a lot going on. And then I like all of the like tense, kind of shows, the Paradise and all that. I love it too. But sometimes you just need a break where it's just silly and they're making food that look really good and they're drinking wine and it's beautiful because it's in Tuscany, which Tuscany is beautiful. Been there.
I've never
been.
Yeah,
I know, Kimberly, we're going to get you there. It is beautiful.
Can I tell you, I was planning for years to go for my 40th birthday.
Oh, okay.
Yeah, that was my plan for a while to go to. I wanted to go to Italy for my 40th birthday.
Okay.
And you know what I did for my 40th.
Yeah. Okay. Well. well,
set me back a little bit.
Well, look.
But I'm gonna get there.
We'll get there. We'll get you there.
I'm gonna get to Tuscany, and I doubt I'll see a fine British brother soaking wet in a vineyard
that happens to be a winemaker.
Right, it happens to be rich and fine and love some Mario music.
Right.
Let me stop. Let me stop giving up the Hope by the time this airs, hopefully everybody that wants to see it will see it, and it's not a whole spoiler.
Yeah.
You've seen
but that's what's so great
but...
about a rom-com. I could watch them over and over again.
Right, and there really are no true spoilers because
you know it's gonna happen.
You know how it's gonna end.
Yeah,
you know how it's gonna
end. And so it's so I like them just it's just like and I know exactly what people are gonna say. The ones I've watched over the years, I've watched them 550. I mean, how many times have we seen Love and Basketball? How many times have we seen Love Jones or what are some other rom-com? Like what are some other I love one of my favorites is Something's Gotta Give with Diane Keaton and Jack Nicholson.
Yeah, because
I can watch that. I've seen that 552 times.
Yes,
and it's like, and that's what this one's like. It's like I know what's gonna happen, but I love that house. Sometimes I just watch it just to look at the house.
And Keena, what did we do after the movie?
Oh, and then after the movie, we went home and we made pasta because it was like, why do I want pasta? Why all of a sudden? So I was like, pasta? Fortunately, for one time, there was actually groceries in my house that I could whip together a dish. And my sous chef, Kimberly.
I was the sous chef. I was chopping.
Yeah, she was getting a little deep on that broccoli. But it was like... So we were able to make a little pasta dish.
Yes. And it was a good time.
Yeah.
And I'll admit, I walked out of that movie thinking, I can't wait till I can see it again.
Mm-hmm.
I'm not gonna pay it. But when it comes out on streaming or whatever, I will definitely sit down and watch it with a glass of wine and maybe some cheese or something, and just have a good time.
Exactly.
So people, if you haven't seen the movie, check it out, or just take a break on a Saturday or one day and watch your favorite rom-com and let your mind rest.
Just rest
and know that you're gonna have going to be smiles in the end.
Right, exactly. You need that. I'm sure a psychiatrist could tell us why you need it, but you need that. You need that break, and get that kind of endorphin rush of just love. So, all right.
Yep.
Well,
all righty.
Thank you. Till next time. Thank you for joining Balance Your Books podcast. We hope you have left with some information to help grow your business. We are here cheering you on. And we'll give you some more nuggets next time.
Yes.
Okay. Bye.
Bye.